Have you ever wondered what makes cryptocurrencies valuable? Well, the short answer is that they are the only assets that exist outside of the current financial system. They require no middleman to transfer, most cannot be censored or shut down, and some even offer an unparalleled amount of user privacy. The real question is why some cryptocurrencies are more valuable than others. Take Bitcoin and Dogecoin, for example. Dogecoin's code is based on Bitcoin's, and Dogecoin has been in the news about as much as Bitcoin over the last few months. Despite these similarities, one BTC is currently worth $50,000, while one Doge is worth just a few cents. More often than not, the reasons for such a large discrepancy between price tags is tokenomics. Tokenomics are one of the most important things to evaluate when analyzing a cryptocurrency, and they're something that's often overlooked. So today, I'm going to take you through the various tokenomic factors you need to know about when vetting a crypto coin or token. Keeping these in mind will make sure you make bank instead of getting burned. Before we get down to business, I need to make my business clear. I am not a financial advisor, and nothing in this video should be considered financial or investment advice. This video is for educational purposes only, so if you watch until the end, you'll be one step closer to having a PhD in cryptocurrency. If this is your first time tuning into the Coin Bureau, then allow me to introduce myself. My name is Guy, and this channel is where no coiners come to die. Cryptocurrency news, reviews, market analyses, tutorials, and crypto conspiracy theories are just some of the topics on tap. If your thirst for crypto cannot be quenched, well, subscribing to the channel and pinging that notification bell might just do the trick. If you want to know what to expect from this video, peep the timestamps I've left on the video timeline. Feel free to skip around if you see a topic that just can't wait to be heard about. And with that said, let's get started. Tokenomics is short for token economics. Tokenomics include a whole series of metrics relating to a cryptocurrency coin or token, such as supply, allocation, distribution, emission, and utility. It is also important to note, although they are often used interchangeably, cryptocurrency coins and cryptocurrency tokens are actually two very different things. Coins are cryptocurrencies that are native to their own blockchains. Notable examples include BTC for Bitcoin, ETH for Ethereum, and XMR for Monero. Coins are used to pay fees on their native network, are used to transfer value, and are given as rewards to miners when a new block is mined. By contrast, tokens do not have their own native blockchains and can even exist on multiple blockchains. Take Cream Finance's Cream token, for example. It exists as an ERC20 token on Ethereum and is also a BEP20 token on the Binance Smart Chain. Instead of being used for baseline network activities like fee payments, tokens often have unique use cases that are specific to the projects that made them. One of the best examples is Decentraland's Mana token, which is burned to purchase digital assets on the Decentraland marketplace. The most important difference between cryptocurrency coins and cryptocurrency tokens is how they are treated by regulators. Cryptocurrency coins function more like, well, currencies. This is why Bitcoin and Ethereum are both currencies according to the SEC. Cryptocurrency tokens are a different story. Many tokens have characteristics that make them similar to stocks in a company. Regulators like the SEC take issue with this, given that there is a lot of paperwork that needs to be done before any company can legally issue or trade securities such as stocks. As you can imagine, not many of these cryptocurrency projects are filing any paperwork, which is why many of them have been hit with hefty fines by regulators over the past few years or even shut down. If you come across a cryptocurrency token that has robust tokenomics but is at risk of being deemed a security by regulators, you might want to think twice before you throw your money at it. A Coinbase project called the Crypto Ratings Council has evaluated the regulatory risks for most of the major cryptocurrency coins and tokens on a scale of 1 to 5, with 5 being the highest risk. If you don't see yours on the list, then you can watch my video on the Ripple lawsuit to help you figure out if the token you're eyeing is at risk of dying. Use that link in the top right to open a new tab and give that video a watch when you're done with this one. The first tokenomic factor you need to check is the supply of that coin or token. Some cryptocurrencies like Doge have a massive supply, which is why Dogecoin is one of the biggest cryptocurrencies by market cap, even though the dollar value of each coin is low. Other cryptocurrencies like Yearn Finance's Wi-Fi token have a small supply, and it's why one Wi-Fi is worth more than one BTC, even though it has 1/4 of the market cap of Dogecoin. Believe it or not, this means that Wi-Fi has more potential to grow compared to Dogecoin. This is because it's easier for a cryptocurrency with a market cap of 1.7 billion to double in value than a cryptocurrency with a market cap of 8.6 billion. This is why you should always pay attention to a cryptocurrency's market cap rather than the actual dollar value of the coin or token, and think in percentage terms rather than dollar terms. Each cryptocurrency's market cap is calculated by multiplying the number of coins or tokens in circulation with the current price of that coin or token. The key phrase here is in circulation. Almost every cryptocurrency has coins or tokens that are not in circulation, either because they've been locked or still need to be mined. This is what that grey bar represents on CoinMarketCap. And you can also see information about a cryptocurrency's fully diluted valuation on CoinGecko, which is the theoretical market cap of the cryptocurrency if every coin or token was in circulation. I will caution that the circulating supplies and fully diluted valuations you see on crypto tracking websites are not always accurate. You're better off going to the websites or block explorers of these cryptocurrencies for the most up-to-date figures. While you're there, you can check out 2 other tokenomic factors. The second and third tokenomic factors to pay attention to are allocation and distribution. Cryptocurrencies are created in 2 ways, by fair launch or by pre-mine. A fair launch is when a small community of people start collectively mining a coin or token. Bitcoin, Litecoin, and Dogecoin are examples of fair-launched cryptocurrencies. There are no coin or token allocations for fair-launched cryptos. Allocation is relevant to any cryptocurrencies that were pre-mined. A pre-mine is when the team behind the project mint some or all of the coins or tokens before opening up the network to the public. A portion of these pre-mined coins or tokens is usually sold prior to the launch of the network to raise the funds needed to build it. As such, many of the coins we see today were originally sold as tokens, specifically ERC20 tokens on Ethereum. It's common for most of the pre-mined tokens to be allocated to the team and private investors such as venture capital firms, with only a small percentage being sold to average folk like you and me in an initial coin offering, or ICO for short. This results in the small circulating supplies we see for many cryptocurrencies. This is a problem because if too many coins or tokens have been allocated to the team and to private investors, it can limit the growth of that cryptocurrency if they start to sell their allocations during a bull run. You can usually see how these tokens were allocated by looking up the ICO details for the coin or token you're researching. ICO Drops and Messari are 2 places where you can easily check token allocations. Again, be aware that the records these websites have might be a bit off. Once you have a sense of how the coins or tokens were allocated, you can use blockchain explorers to see how the coins or tokens are currently distributed. What you're doing is double-checking whether or not the stated allocations are correct for pre-mined tokens or coins, and whether the distribution is equitable for older coins or tokens, regardless of whether they were a pre-mine or fair launch. If you're researching an ERC20 token, use Etherscan. If you're researching a Binance DeFi token, use BSCScan. If you're searching up a coin with its own native blockchain that isn't Bitcoin, you'll have to find their own block explorer. You'll be surprised at how hard it can be to find out how coins are actually distributed on these block explorers, and I think that's usually by design to obscure just how inequitable those distributions are. Anyways, using Etherscan as an example, you can clearly see how Decentraland's Mana token is distributed, even though it was pre-mined. You might be alarmed at those 3 wallets holding a substantial amount of the supply, but if you look closely, you'll notice all 3 are smart contracts and not actual wallets. Besides those 3 smart contracts, Mana's token distribution is actually quite good. There's no single wallet that holds a concerning amount of the total supply of Mana. The same cannot be said for Dogecoin. One wallet holds over 28% of Doge's supply, even though it was a fairly launched cryptocurrency. Too many tokens in too few wallets means there's a risk that these whales could dump their crypto on the market and crash the price at a moment's notice. The problem is that what you see on these blockchain explorers is only half the story, and that's because of two additional tokenomic factors. The fourth and fifth tokenomic factors to look out for are vesting and inflation. Vesting applies to pre-mined cryptocurrencies and refers to how the coins or tokens are expected to be allocated over the coming months or years. It is common for cryptocurrency projects with a pre-mine to lock up a certain portion of their tokens and gradually release them over time. This increases the confidence of regular token holders that the market won't be flooded by tokens allocated to the team and private investors. Usually, these vesting schedules are pretty logical and take place over many years. If you see a vesting schedule that looks like this one, though, then be extremely careful. Unlocking too many tokens at once or within a short time frame can sink the price action of that token in the short term. When it comes to inflation, a cryptocurrency is either inflationary or deflationary. If a crypto has too much inflation, it can reduce the value of the coins or tokens already in circulation over time. Unless the inflation schedule is extremely aggressive, it will have little to no effect on the short-term price potential of a cryptocurrency. Proof-of-stake cryptocurrencies often have some degree of inflation to incentivize validators and delegators on their networks. This normally ranges anywhere between 5 to 15%, with some cryptocurrencies like Polkadot adjusting their inflation based on staking participation to maintain the security of the network. Many DeFi tokens also use inflation to reward liquidity providers and yield farmers on their respective protocols. DeFi tokens often have incredibly aggressive inflation schedules to keep their annual percentage yields high, so much so that Vitalik Buterin likens their tokenomics to the Fed's money printer. This is why many, including Yearn finance creator André Cronje, advise, quote, "Do not buy it, earn it." In other words, it's better to earn these DeFi tokens as a liquidity provider or yield farmer than to buy them on an exchange. If a cryptocurrency is deflationary, the reduction in supply increases the value of that cryptocurrency over time. While this may also not have a big influence in the short term, this deflation is part of why cryptocurrencies like Bitcoin are so valuable. Although new BTC are mined every 10 minutes, Bitcoin has a maximum supply of 21 million, and the amount of new BTC being created per block is cut in half roughly every 4 years. The last BTC will apparently be mined within this century, and you can watch my video about what happens after that by clicking up there in the top right. Now, you might be thinking, but Guy, Bitcoin has a maximum supply, that's not deflationary. Well, the reason why Bitcoin is deflationary is because of accidental loss. A good example of this is Ripple's former CTO, who can't remember the password to a hard drive containing over 7,000 BTC. These sorts of incidents will continue because of human error, and each time they happen, it reduces the total supply of BTC in circulation. This means that cryptocurrencies with a maximum supply like Bitcoin are deflationary in practice. Conversely, some cryptocurrencies intentionally reduce their supply by burning coins or tokens. For example, an upgrade to Ethereum that's currently in the works would burn part of the ETH used to pay for network fees. Even though Ethereum is technically inflationary, if enough people are using the network, the fee burns will be more than the inflation, which would turn ETH into a deflationary asset. Some believe that this change could propel the price of ETH well past $20,000. Unfortunately for the people staking their ETH on Ethereum 2.0, they probably won't be able to realize those gains even when they come. This brings me to the final two tokenomic factors to take into account, and these are staking and utility. When you stake a cryptocurrency as a validator or a delegator, those coins or tokens are usually locked up for some period of time. In the case of Ethereum 2.0, any ETH being staked will not be unlocked until 2022 at the earliest. This means that if the price of ETH starts to skyrocket, all that ETH being staked is not going to be making it onto any exchanges. This conveniently restricts the actual circulating supply of ETH, which could enhance that positive price action. This effect is much bigger for other proof-of-stake cryptocurrencies like Polkadot, where more than 60% of DOT's supply is being staked. These DOT tokens are subject to a 28-day unlock period. This might not sound like much, but consider that explosions in price only last for a few days or weeks before correcting. 28 days would be more than enough time for people who are not staking to capitalize on that sweet positive price action. That said, some proof-of-stake cryptocurrencies like Cardano have no lockup periods for staked coins. This means that all of that staked ADA could move onto exchanges at a moment's notice and push a parabolic move back down as people take profits. Besides its restrictive effects on supply, staking is also a common utility for many coins and tokens. Utility is also referred to as a use case and includes basically anything that drives demand for a cryptocurrency coin or token. Bitcoin's primary utility is as a store of value like gold. The difference is that Bitcoin is accessible to basically anyone with an internet connection, whereas gold requires a bit more infrastructure to get your hands on and store. Given how poorly fiat currencies hold their value these days, there is a lot of demand for an easily accessible store of value like Bitcoin, hence why it is the most valuable cryptocurrency on the market. Ethereum's primary utility is to pay fees to use the decentralized applications built on it and move any ERC20 tokens around. There are hundreds of dApps and thousands of ERC20 tokens, which means a lot of demand for ETH to pay gas fees, hence why it is the second most valuable cryptocurrency on the market. Many DeFi tokens have utility as votes in the governance system for the protocol they belong to. As the total value locked in a protocol increases, so too does the demand for its governance token. Now, interestingly enough, the market caps of many DeFi tokens like Aave are almost one-to-one with the total value locked on their protocols. This makes it easy to spot DeFi cryptocurrencies that are undervalued or overvalued. There just so happens to be a new DeFi ecosystem that is teeming with these undervalued tokens, and you can learn all about it by watching my recent video. You know where to find it. And there you have it, folks, all the tokenomic factors you need to tackle the crypto market. Cryptocurrency coins and cryptocurrency tokens have their own pros and cons. While cryptocurrency tokens may be more profitable investments, they are also riskier to hold because of the regulatory risks they face. Moreover, token profits are often short-lived, as many cryptocurrency projects with tokens aren't built to last for more than a few years. Cryptocurrency coins often support larger ecosystems, which include dApp cryptocurrency tokens. This gives coins a longer shelf life and results in a more gradual increase in value as their ecosystems grow. This growth in value isn't always obvious if you're working off of the price alone. Small circulating supplies can also threaten that value in near or distant future if any of those idle coins or tokens start to move onto the market. That's why I usually value cryptocurrencies based on their fully diluted market caps. This makes it easy to spot when a cryptocurrency is overvalued or undervalued, regardless of its price tag. Unfortunately, truly valuable fair launch cryptos are hard to come by these days. That's why, if I was ever to make a Dogecoin cryptocurrency, it would be fair launched and not pre-mined. There would be no allocations or vesting schedule, and if I got enough of you to mine it with me, the distribution of Dogecoin's supply would be equitable. While I'm not the biggest fan of inflation, I think that some degree of coin or token printing is necessary to incentivize miners to continue supporting the network. As such, Dogecoin's inflation schedule would be minimal, and a small percentage of Dogecoin would be burned when paying for fees on the network. Dogecoin's utility would be for staking and to pay for cutting-edge community-made crypto content on the Coin Bureau protocol, which runs on the Dogecoin blockchain. Sounds like the next big cryptocurrency to me. If you enjoyed this video, then be sure to smash that like button to let the algorithm know. In just over a month, the Coin Bureau has grown by over 100,000 subscribers. So, give in to your instincts and join the merry throng by subscribing. Pinging that notification bell will make sure you don't fall behind the pack. And if you want to get daily updates about the crypto market, then join the Coin Bureau Insider Telegram channel. You can also follow me on Twitter and Instagram to get my hot takes and see what's going on behind the scenes here at the studio. If you want to support the channel while flexing on your no-coiner mates, then head on over to the Coin Bureau merch store and pick out a stylish shirt or hoodie. There are a dozen designs and dozens more are on the way. On that note, I'd better get on my way and back to my research. Thank you so much for watching. I'll be seeing you real soon.